Hello, Sector Watchers. Welcome to the 21st episode of Sector Spotlight on Tuesday, the 3rd of March, Super Tuesday in 2020. This is your weekly update on sector rotation and anything remotely connected to sectors, relative strength, and/or rotational analysis. My name is Julius Kempenaer, and I'm your host for today's show. I'm based in Amsterdam, the Netherlands. Rachel and Zach, our fearless technician and producer, at the office at StockCharts in Redmond, to make sure that everything will run smoothly. You can always send me an email with questions and suggestions, but if you want to participate while we are live, the chat box is open and we will monitor what's coming in, so don't be shy. Ladies and gentlemen, let's get started with Sector Spotlight. The agenda for today is that we will have our usual overview of performances of the various asset classes and sectors. And because it is the first Tuesday of the month, we will take a look at monthly charts. Not sure how long that's going to take, but at some stage we're going to have a short break. There is at least one question from the mailbag. And then if we're lucky, we're going to get through a pair trade idea, but things are flying all over the place. So I'm not totally confident that we should do that, but we'll discuss that later on. Let's get started with some charts. It was a wild week. The asset classes are showing the strongest performance for treasury bonds, not surprisingly. And we have equities down about 1.5% over the last 5 days. Obviously, that was much more, but we had a stellar run up yesterday, some sort of a relief rally. We'll look at that later on as well. The big outlier, at least in my opinion, is real estate, which is down 4.7%. Makes it a massive underperformer of the Vanguard Balanced Index Fund. Especially in these times, we would and should expect real estate to outperform. So I'll be looking at that chart later on. If we look at the RRG that belongs to this asset class performances, you'll see that the iShares Core S&P, so the stock market ITOT, is now definitely heading towards the lagging quadrant inside weakening, but it definitely has a weak heading, a weak RRG heading, while this whole cluster of asset classes here, and that includes the US dollar, government bonds, corporate bonds, real estate, still here. This is a good example why just 1 week or 5 days of performance is not necessarily immediately affecting a weekly RRG. And we got high yield here. The one asset class that is definitely underperforming and shooting further down into the lagging quadrant is commodities. By the way, if I quickly show you the daily rotation of this one, you can see that V and Q has been very negative the last few days, and you see this whole cluster here powering into leading while stocks are now powering into lagging. All in all, a risk-off message from this point of view. If we quickly move on to the performance chart for the sectors and we bring up the RRG for the sectors, we'll do the same exercise. In absolute terms, surprisingly, technology is up 1.3% over the last 5 days. If I bring that back 1 day, then you'll see that everything is negative, though. That doesn't work. Anyway, surprisingly, technology, the only sector up. That's not necessarily a defensive sector. We've seen the beta overlay recently, and technology is a high beta sector. So, kind of confusing here, especially when you see healthcare, communication services, staples, etc. On the left-hand side, so outperforming. Here's the outperformance side, and you see that technology, healthcare, communication services are the ones that are doing best. Staples, close to the benchmark, and the underperformance comes from utilities, real estate, energy. Again, a couple of very defensive sectors here. So that whole offensive, defensive picture is being thrown around. look at it on the RRG, we'll see a very clear message from the energy sector, which is powering further into the lagging quadrant. That is for sure one of the sectors you do not want to be invested in. The same goes for the financial sector, which is right here. And we have industrials, we have materials, which is also powering to the left. And then we've got a few inside improving. Remind you, this is the weekly RRG that are turning towards the leading quadrant. So they are improving rapidly, especially real estate, staples, and utilities, with real estate, the one that's confusing between daily and weekly. And you will see that the discretionary one, especially that last bit here, is starting to fall over and hesitate. So I'm not sure how strong this rotation is going to be. Lone Ranger inside leading is technology. Look at the short week-to-week observations on that tail and compare the length of this tail to the other ones here. And it still shows that technology is an outperformer, a very stable sector, way to the right, and has just been joined by the communication services sector, which just crossed over into the leading quadrant. But this is very close to the benchmark, and that trail is very, very short. So communication services for me is in line with the benchmark. So that's it for a little bit of the overviews. Now let's move to long-term charts. I'm going to do the asset classes are here, and what I wanted to do is bring my PowerPoint back and give you this chart here. So if you look at the, let's bring the asset classes back very briefly here. This is a high-level overview, and you can see that this is a risk-off setting for the asset classes. We got stocks here, they are red. We got commodities here, they are red. I got the dollar in blue because, and I'm going to show you why. If we do the summary, I can give you the US dollar chart, because that is starting to move sideways. By the way, just before the show started, I saw a message that the Fed has lowered interest rates by 0.5 percentage point, which is massive. And also means a massive move for euro dollar, at least. It jumped like 50 to 60 basis points within like 30 seconds. So we'll have to see what's going on there. The longer term picture still suggests that we're moving sort of sideways. Let's work our way through these long-term charts. So we got the stock market here. I'll quickly go. So this is the new one that we introduced. That's ITOT. I have annotated the SPY chart, and especially this one I wanted to share with you, because we've discussed this one a while ago, both in blogs and on Sector Spotlight. And I'm not sure if you remember that we discussed breaking out of that rising channel. That was on actually exactly a month ago on the first show of February. And I said, you know, when we drop back below that resistance level, which at that time was support, I expect a rapid decline towards the lower boundary of that channel. Well, I mean, no way I could have known that it would go that fast, but it worked. And what I'm pleased to see is that these support levels here, these rising support levels, are now kicking in really as support levels. So for the time being, this decline is being caught by these rising trend lines. And I think that the next few weeks will be pretty crucial in defining the pattern and the scenario for the coming months. Especially the rally that we're now seeing, the rally and the next correction. If the rally is going to put in a lower high, and I think you should switch to weekly instead of monthly charts to actually do that, maybe even daily, then that's a negative, because that means that supply is coming back earlier. then that next leg down will be crucial, because when we break those previous lows, then the next target will be the long-term support line, which is the thick red line, and it's around 260. It goes up every month a little bit, but right now I'd say it's around 260. So I'm going to watch this market like a hawk, especially to see where potentially a new peak, a new top is going to be formed, and out of that top, where that decline is going to be caught, or if it's not caught, when it's going to break below these support levels. So much for stocks. So they're still in an uptrend. For the short term, I'd be negative, because I think that, especially when you look at the RRG, you will see that there is a negative rotation going on, hence that like sort of medium term red for stocks. The long term, I think we need to work out, and if we start forming some lows and start picking up, we will see a rotation back to leading very rapidly. Move on to government bonds. I've not annotated this one, but this is a strong chart. It's a strong looking chart. And I actually want to go to the unadjusted versions of these GOVT and IE charts, because there you see the true support and resistance levels, because these are the levels that people have in their minds. And you see a very significant break for bonds to the upside, which is underway, and there is plenty of room to jiggle, room to move to the downside before this turns negative again. So the next couple of weeks, I expect government bonds to do really well and actually do better than stocks. The same goes for the 7 to 10 year Treasury bond. This is the 114 level that we've been discussing a number of times on the show. That is now clearly broken, and it will come back as a support level. At least that is what you may expect from this level. And then I quickly go through investment grade corporate bonds. That's a breakout. We've seen that for a while. That's still going strong. We've seen high yield still being caught below that, now getting stronger resistance area in that, what is it, just above 90, just below 90, 98 and a half, probably like that. And then we got real estate, which is also here in unadjusted terms, broke out, come back, but now that 85 level seems to be working, and we're already back up to 93. So that will probably bring that daily rotation back in line with the weekly, and make real estate one of the outperforming asset classes. Commodities, strong underperforming, caught in a range at support right now, but I wouldn't be betting on it to hold. Let's quickly move to the next level here, the yield curve. Do this really quickly, because otherwise we'll be running out of time. I already know that for sure. The yield curve is clearly in favor of the longer term bonds and not so much of the shorter term bonds. So in fixed income investments, I think the overweight positions, or if you have positions, they should be at the longer end of the curve. And if you go into the commodities market, we're not going to look at any of those charts. You'll see that grains and precious metals are the groups that are outperforming. We've discussed the liquidity issue with these indexes and these ETFs. I'm going to try to find some proxies for that in another show. Let's move to the stock market, and more precisely to the sectors, and then look at the monthly charts. There you go. Forget SPY. I'm going to look at materials. These colors are based on the RRG of the sectors. So you'll find XLB materials in the lower left corner in red, because it is in lagging. And if you look at the monthly chart, that is totally justified, because it was not able to break that overhead resistance level. It dropped back, and we just barely hold above that support line. There's a lot of overhead resistance there. So materials is one of the underperforming sectors for the time being. We move to communication services. As I said, it's in line with the market. and you see there's not a lot of action here. The chart in itself still looks pretty good, but it's not outperforming, nor is it significantly underperforming. Hence the blue neutral color on the graphic there. I'm going to look at energy from an unadjusted point of view because dividends have a big impact on this sector. And you see that it broke again below important support levels, which makes it a very weak sector in my overview. And it is confirmed on the RRG where it is way down into the lagging quadrant. Let's move to financials, very important sector. And you see that it is still in that uptrend, but it is having a lot of trouble with that overhead level around 30. And if we bring that onto the RRG, you'll see that it has just moved into the lagging quadrant, and we're still moving in there. The heading is still negative for the financials sector. Let's do one more before the break. So we got industrials here. That is a negative. And the reason is because it broke above it and then it dropped back below it, and that level around 77 something is now coming back as resistance. And look at the position on the RRG. It's inside lagging, picking up a little bit of momentum, but there is not a lot of power behind it because that trail is so small, so short compared to the others. We are going to a very quick break, and then I'll continue the monthly charts for the remaining sectors and tick off some of the other boxes that we have to do. So stay tuned, and we'll be back in a couple of seconds. And we're back. Continuing where we left off, and that is the next sector, which is the technology sector. And I have not annotated this chart, as you may notice. And the reason is because I don't know what I should annotate. It is still, I mean, yeah, it got a beating last week, but it also rallied this week. And you can see that if you step back from all the madness that's going on in the markets right now, and I would give you this chart without the time scale, without the price scale, I'm 100% sure that all of you, literally all of you, would say that this is a bullish chart. So, you know, we're going to just stick with it and see how this all develops and not panic. Well, there is no reason to panic yet. It may come, but I don't see it yet, at least not for the technology sector. So that is one of the lone rangers in green on this investment pyramid. By the way, it's still well inside the leading quadrant, losing a little bit of momentum, but not much, still traveling to the right, which is all good. Let's move to staples, notoriously a defensive sector. Look at it on the RRG and you will see that it's improving, but it's a short tail. I mean, the last piece of velocity is increasing, so it's picking up right now, but it has not done that over the last 5 weeks or 4 weeks before last week. So it's just waking up. And if I look at it, then what I like here is the fact that we broke above that 55 level. We dropped back into the channel. According to my theory, we might be looking for support just below that 55 level against that rising trend line. Maybe 55 will catch it. I don't know. We'll have to look and see. But as long as we remain above that dashed line, that horizontal dashed line around 55, a little bit higher, I think staples are still positive, and they might pick up a faster rotation on the RRG, and then they will eventually turn green in the investment pyramid. Real estate, the one that's confusing us right now. Let's move to the unadjusted one because this also is heavily impacted by dividends. the break out of that range was very important. That happened already back in the beginning of 2019. We corrected back. We did not get back to the breakout level, which is good because it looks like we're putting in a new low above that level. Mind you, this is a monthly chart, so that last bar is only one and a half day old. So we've got to be careful with that. For the time being, that 35 level seems to be good support, making the real estate sector a blue one for me because it is inside improving. It's got a long tail. It's rapidly moving towards the leading quadrant. So definitely one of the sectors together with XLP that I'm keeping an eye on as a safe haven when push comes to shove going forward. Utilities, need to go to the unadjusted one. The other one, which is in green, and the reason for that is that this one broke out of the rising channel, tested it, rallied, tested it again, but did not really come back. It's still well above that former rising resistance line, which makes it one of the stronger sectors at the moment. And you will also see that in the RRG, where utilities is almost crossing over to the leading quadrant. If we have a few more good days this week, and we've got plenty left, then this could be the move for utilities into the leading quadrant and making it one of the leading, if not the leading sector going forward. We go to healthcare. This one is confusing me because the pair trade idea that we launched last week was long utilities and short healthcare. It was totally based on the seasonal performance for those sectors, which has healthcare an underperforming sector in 70% of the time over the last 20 years. I am not sure how that will pan out with this virus pandemia working its way around the world and people betting on healthcare companies coming up with a vaccine or something like that. But I'm not going to speculate on all of that. I'm just going to look at what the charts tell us. The seasonality says that healthcare is supposedly a weak sector in the month of March. And if I look at the RRG, then healthcare is still following that seasonal pattern. It's continuing its rotation with a negative heading towards the lagging quadrant, although the velocity is shortening a little bit. So we're going to keep an eye on this one, but the long-term chart, the trend is still healthy. From a relative point of view, it's not so strong. Let's quickly move on to the last chart of the sectors, and that is, oops, that's the list. I need to go to this one here, and that's discretionary. Not really an offensive sector, but it still looks pretty good. And if you look at the RRG and we bring in discretionary, it's inside the improving quadrant. What borders me here a little bit is look at this one here. This is last Friday, and this is now. So sorry, say again. This is Friday a week ago, and this is the week ending, should be beginning March 2nd. So this is yesterday, and it's it's losing a little bit of its mojo. So this could be turning around, making it or behaving like a offensive sector in a weak market and turning around. But it's really early to make that call. If you look at the price chart, it's holding up well above that former resistance level around 115. And as long as it does that, then discretionary could be one of the better sectors. And it brings it basically together with staples. Discretionary is ahead of staples, but they're moving in the right direction. Tails are relatively short, so it means that they're stable trends. There's not a lot of power behind it yet. If you compare that with like real estate and utilities, these are, look at the difference between the observations. These are powerful moves. Anyway, these were the monthly charts for that closed at the end of February. They're weird charts. They're well, weird and wild because we've had such big swings during the month of February. We will have to keep a close eye. I'm going to do that. I'll keep you updated through the blogs and in the show. I want to do one. Yeah, we'll manage that. I got one question that I think was actually super interesting. Oh, I see that there are a few. Please clarify how many years look back are used on your two seasonality by sector tables. 20 years of look back. That's the spreadsheet that I'm using and that people can request. That uses 20 years of seasonal data when they are available. So for real estate and communication services sector, there's not 20 years available. That we use like whatever there is. I believe it's like 13. And the other one is your new way of showing asset classes is an easy to understand and time-saving way to see the big picture. Well, yeah, no worries. I thought it was a question. Thanks, Dan. Appreciate it. I want to go to one question that came in via the mail. I'm going to read it out to you. Can your graphs indicate when to switch between pairs such as SSO, SDS, QLD, QID, TLT, TPT? And if you don't know what these tickers are, these are, most of them at least, the ultra ETFs. So they are ETFs that multiply. So they're leveraged ETFs, basically. They multiply the result of a sector or an asset class twice. It's a pretty long story to explain all of that right now, how that works. But let me quickly bring up an RRG with those. First bring up SSO and SDS. And these are ultra ETFs covering SPY. So we'll leave SPY as the benchmark. And what you see here is sort of a complete opposite. And so the blue one here is the ProShares Ultra Short, and the yellow one is the Ultra. So the yellow one, the return of the yellow one is twice the return of SPY. And if that's negative, you get twice the negative return. And if it's positive, you get twice the positive return. I got to admit that initially my take was like, yeah, well, that's twice the return of SPY. So, or the other one is the Qs, is the NASDAQ. Just look at the rotation of SPY, and you know, when you use SSO or SDS, that is implementing a view based on your analysis of SPY. Until I punched them into an RRG, and what caught my eye is that these tails are opposite, and they are, but they're also different. And the big difference is the length of the tail and the velocity on the observations. And the reason for that is that your leverage on your down days has a much bigger impact than the leverage on the up days. And I believe I tried to look it up before the show, but I couldn't really find it. I believe there was a nat gas ETF, ultra short, that sort of went to zero because that went, or ultra long. So nat gas went down and ultra long almost went to zero because every day that underlying value kept declining, that ETF started to deteriorate even further. So I'm going to keep an eye on this. It's a very interesting way of looking at things, especially at this. And it looks like this short ETF holds the key because it has such a long tail and big moves. Anyway, and please don't be a stranger. Stay in touch. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. Meanwhile, if you want to read more about sectors and sector rotation, please go to the RRG blog on StockCharts.com.